Hello, and welcome to this lesson which will introduce you to the topic of corporate strategy and how to get a seat at the CEO's table. After you have finished this training, you will be able to, firstly, understand what is meant by corporate level strategy. Secondly, identify the key questions that should concern a CEO. And thirdly, understand our corporate strategy framework for assisting a CEO. To begin with, let's look at the main differences between corporate strategy and business unit strategy. Corporate strategy focuses on an organization's entire business unit portfolio, the big industry and consumer trends affecting the organization, and how resources are allocated across the organization. Corporate strategy is also responsible for the organization's vision and mission statement, and managing investor relations. The head of a corporate strategy team will usually report in to the CEO. By contrast, business unit strategy focuses on understanding the changes in the unit's immediate business environment and achieving competitive advantage via new business models, new customer segments, new products or services, or new capabilities. For more information on business unit strategy, please consult the separate Pontema training lesson. Several factors can trigger a corporate strategy review, and these are related to external trends shaping the organization's industry, the performance of the business, particularly when in decline, slowing market growth, or due to investor-related concerns. In addition, a change in leadership, particularly at senior level, can trigger a review of the portfolio of business units. Corporate strategy work can be organized around 6 core themes, each of which may be a higher priority than others at any point in time, depending on what has triggered a corporate strategy review. These themes form the basis of our corporate strategy framework, and which will be referred to during the remainder of this lesson. Firstly, the corporate vision and objectives element clarifies the organization's identity and values, and then defines its mission, vision, and overall ambition. Secondly, the corporate portfolio strategy defines the organization's business unit portfolio logic, portfolio roles, and how the portfolio will develop over time. Thirdly, the corporate growth strategy will develop incremental or step change options to grow the organization. Fourthly, the parenting strategy will align the corporate center's role and organization and define its operating model. Fifthly, the capital allocation strategy will define use of financial and human resources, including mergers and acquisitions, or business unit divestments. And lastly, the investor strategy will identify the right investor type and lay out a compelling investment thesis for them. Each theme of the corporate strategy framework raises important questions for a CEO and the board, some examples of which are shown in the slide. For example, if a portfolio strategy review is the priority, a CEO needs to ask which of the organization's business units are healthy and the cash machines, and which are performing poorly. Under growth strategy, a CEO needs to question where growth is coming from, and whether new growth engines are needed, and whether current innovation levels are sufficient in the organization. And under capital allocation, if this is deemed a priority area, then a CEO will be asking how scarce capital is allocated across the organization, and whether money should be spent on new acquisitions, or indeed recouped via divestments. Now let's examine each theme of the corporate strategy framework in more detail. First up is shaping the organization's vision. A vision is a description of where the organization wants to be in 5 to 10 years from now. A meaningful and accepted vision is the basis for the development of a corporate strategy and future value creation. This is because the vision is supported by a corporate strategy which outlines how the organization will get there and realize its vision. For example, via organic growth or acquisition of new capabilities. There are several potential reasons to engage in a review of a corporate vision, such as a fundamental transformation of the corporate portfolio, perhaps after divestments, or due to a change in leadership. In terms of developing the vision, this is typically a 4-step process. The first step is to collect propositions for vision themes and diagnose an organization's inspirations or uncertainties about the future. The second step is about synthesis and develops options for vision statements using common themes and consistent combinations. The third step is about crystallization and involves the board selecting a vision and testing it with certain parts of the organization to check if it fits the culture. Finally, the fourth step is about communication, which is where the new vision is marketed throughout the organization to ensure it is understood and to secure buy-in. All the steps require senior-level engagement and are usually played out in workshops, focus groups, and interviews with representatives from around the organization. For more information on vision development, please consult the separate Pontema training lesson. The second theme of the corporate strategy framework is business unit portfolio management, which defines the organization's business unit portfolio logic, portfolio roles, and how the portfolio will develop over time. Organizations use portfolio management primarily to create transparency across businesses and to identify actions at both the individual business unit level and overall portfolio level. Weak acceptance and support of the actions on the part of the business units is likely to lead to poor corporate decision-making. There are several potential reasons to engage in a portfolio review, such as a historically healthy core business in decline, lack of growth in the portfolio, unclear portfolio logic, or a change in leadership. Analysis here typically focuses on matrix-based work, which categorizes business units into those with good prospects and those with declining prospects according to, firstly, how attractive the market is in which they are operating, and secondly, the competitive strength of the unit in that market. Other matrix criteria, such as current and planned returns, parenting advantage and linkage advantage, which means value from improved cooperation and synergies across business units, are also possible. These matrices provide a way of considering appropriate strategies given the positioning of the units. Units with the highest growth potential and the greatest strength are those in which to invest for growth. Those that are the weakest should be divested or harvested. In other words, used to yield as much cash as possible before divesting. The third theme of the corporate strategy framework is growth strategy management, which concerns incremental or step change options to grow the organization. There are several potential reasons to engage in a growth strategy review, such as a new CEO wanting to explore new growth areas, investors demanding certain growth rates, and a need to identify growth opportunities to compensate for growth declines in other areas. In terms of evaluating growth opportunities, one way to map out growth options is where to play, which is what markets you choose to pursue, and how to win, which is the method of accessing a market to achieve competitive advantage. In the slide, I have defined 7 growth levers that span the growth opportunity space and guide growth strategies, such as geographic expansion, innovation, and go-to-market transformation. In general, many organizations have a bias towards limited parts of the framework, Although organizations shouldn't spread themselves too thinly, they can benefit by stretching their thinking and using several parts of the framework to challenge their current growth plans. Please see the Strategy in Practice lesson for a deeper review of this growth framework. The fourth theme of the corporate strategy framework is parenting strategies, which concerns aligning the corporate centre's role and organization and defining its operating model. Corporate centres generally create value via 5 distinct levers. Firstly, they have financial advantages, which means providing access to cheaper external capital by having greater negotiating power or optimizing tax across the organization's portfolio. Secondly, corporate centres have strategy development advantages by providing overall vision and strategic direction for the business units and can actively promote specific projects. Thirdly, they can support business units in recruiting and talent management and providing central assets such as technologies, brands, and patents. Fourthly, corporate centres can foster operational engagement by steering business units via operational budgets, monitoring, and closer cooperation, and intervening to actively improve business unit performance. And fifthly, they can ensure business units collaborate to increase sales, for example, via cross-selling activities, or to realize economies of scope and scale. Internal research can be conducted by interviewing senior managers to understand how the corporate centre is perceived by the business units. Results can be plotted on charts, like you see in the slide, to highlight perception gaps and key areas for management's attention. The fifth theme of the corporate strategy framework is capital allocation, which defines the use of financial and human resources, including mergers and acquisitions or business unit divestments. A key aim here is to create transparency on the current investment portfolio and investment process, so the leadership team knows where it is investing capital and operating expenditure in order to manage and grow the organization. There are several potential reasons to engage in a capital allocation review, such as excess cash or a cash shortage, requiring a revisit of the allocation process, a lack of a return on capital, or performance issues on large investment projects. A framework to evaluate capital allocations focuses on 5 main areas. Firstly, create transparency on the current investment portfolio and funding process. Secondly, translate strategic priorities into investment guidelines and budgets for the business units. Thirdly, systematically evaluate and prioritize investments based on differentiation criteria. Fourthly, define shifts in capital allocation for short-term impact, such as reducing capital allocated to an underperforming project or increasing capital to an overperforming project. And lastly, set up a governance and investment review process according to industry best practices. The final theme of the corporate strategy framework relates to investor strategy, which is about attracting the right type of investor and laying out a compelling investment thesis for them. Investor insight is a key input into investor strategy, and an organization needs to identify what's important to investors. The organization then needs to develop compelling communication materials, highlighting its investment thesis, which is developed based on the organization's core beliefs and planned strategy. Investors are like consumers, buying equity or bonds instead of products, each seeking different attributes in their investments, which they use to assess whether to invest in a specific organization or not. When organizations, and especially CEOs, can articulate a clear investment thesis, highlighting their position on those specific attributes, it becomes easier to attract investors who have complementary goals. A key aim here is to find an organization's natural investor type, which are investors whose preferences are well aligned with the company's investment thesis. A final thought as you complete this Introduction to Corporate Strategy lesson. Developing the strategy thinking should be a combination of two schools of thought. Firstly, it should be developed by a thought process based on senior management experience and creative thinking. And secondly, it should also be derived through an analytical process whereby options are presented to senior management based on data and qualitative reasoning of the organization's competitive position, industry, and trends. Although the approaches are complementary, striking a balance between both schools of thought are needed to secure the buy-in of all stakeholders and to ensure the best quality of decision-making. Thank you for participating, and see you next time on another exciting business training lesson from Pontema.